Welcome back to another Market Insight. We are back to full strength. Aaron is back. Some would say he was vacationing. I would say he was getting the consumer behavior out there, trying to see how the
Definitely
consumer's
some research out there. You know, we had to go through Disney. I would say that the consumer's weathering the storm from that, but that research gave me a good tan.
Yeah.
5 weeks out of 6 in Florida. It was nice.
So the consumer got feeling that a little cautious, but still willing to spend.
You know, that we were looking at the Lightning Pass, and they now have a new supply and demand, so maybe that becomes an indicator in some of the research that we're doing. Super excited about the new alley, the table, the new sign. If you haven't checked yet, we have a rebrand on our website. Go ahead and visit that. And I know a lot of the concepts that we cover, we're getting that built up. And while you're there, make sure you're subscribing to what we're doing here so that you keep up to date. I know we're going to be talking about tariffs today, so you never want to miss these things because we're always dealing with the headlines that is really coming at you.
The new setup, right? It took a long time. We started off standing in front of a TV, and then we sat around a little round table. And then we became newscasters sitting in front, exactly looking at the camera. So a lot better to be in podcast form. But back to the consumer, I said it tongue in cheek, but that's what we want to talk about is the headlines, the working through whether it's the hard data, the real actual reports of the economy versus the feelings, the emotion, the soft data. We want to go through those. The first few slides will be a little difficult because it is the hard data, and I just wanted to show where we've come from. And the fear starting off this year, there were a couple bad reports we got. We got a weak retail sales report in January and really weak housing data. The housing data is correlated to interest rates. Rates were really high. So and we got a weak PMI data from the expectations of weak PMI. So that was the first thing I wanted to show. I wanted to start, and the way we read these charts is the actual number is what was on the left and the consensus was the expectation on the far right. And I put squares in green to show what we're actually looking at. So these PMIs for services, we see the consensus was lower than the actual. And that's because these are the final readings. We had preliminary readings, and they had really spooked the market that they were coming down. Anything above 50 is still growth, and a couple of the numbers, one of the numbers was below 50. And that did spook the market. But when we got the actual numbers, they came out strong, better than feared. So when we were looking at least the initial PMIs from the hard data a couple weeks ago, we got good numbers. We never put too much weight in one number, but the market seemed to be. They were starting to say that this is really weak. Initial jobless claims came in well behaved too. 2 weeks in a row, really what you'd expect, 220. A really weak economy, you're going to start seeing over 300,000 initial claims per week. So it's something to look at, but of course it's backward-looking data, but the backward-looking data was at least strong. The next report came last week. This was one of the most interesting ones. I think it explains where the market is perfectly. So it's the JOLTS report, job opening, labor turnover. The number was healthy. It was a number that was above expectations for job openings, a good sign. The internals were pretty good too, with people willing to quit their jobs and finding new jobs. But what happened, as soon as this number comes out, the market starts to recover a little bit, and there's a tweet from Trump talking about escalating tariffs, significantly higher tariffs on Canada. Market immediately gives up the gains and starts selling off the rest of the week. And that's exactly where we are right now in the market. We're tweet headline to headline.
So if I can summarize what I heard you say is that the hard data, the actual things that are going on in the economy, is actually above consensus. And consensus have been that soft data, that survey, the emotional feeling about the economy has been sluggish.
Yeah.
But we're not seeing that in the data. Obviously, there's concerns. Does that soft data, does the emotional component actually spill in and become a self-fulfilling prophecy? What are your thoughts on that?
That's the hardest part right now. And when you have a market that's down 10%, not performing well, it's pricing in a lot of that weakness. Mm-hmm. And these are backward-looking data. I did just want to show two more pieces to show that, well, that fear that came out last month on housing starts. We had a great housing start number, significantly above the consensus at 138. We got 1.5 million. That's a one-year high for the number. So, in industrial production, the actual, now this is actually a good differential between the prior administration. That industrial production number comes out 5 years ago. Trump would be tweeting about it. It was a great industrial production number. I didn't see any mention of it because they have started to look the other way. They say they're not looking at the market, and they're probably not.
Well, it would be concerning if they aren't looking at the data because there's a lot of impact that the government does. I think that's where the fear is coming. So I don't know that I share the sentiment that they're not looking at the data, but I think people can make a claim that they're not, and they're certainly not responding in the way they did in Trump 1.0. Obviously, this is troubling. You want to talk about the tariffs and just like all the headline risk, or what do you want to go over?
Let's go over the soft data that you mentioned.
Okay.
So let's just show how weak it really is. And this is just, we'll start with a bearish sentiment indicator we've used on here a lot. The only difference was I made it larger so that it goes back to 2008. You usually don't do that. Usually there's no reason to do that. But what we're looking at is a survey of individual investors and saying a 6-month view for stocks, are you bearish? And this peaked last week at 60% bearish reading, which is a recession. It's the bottom of a recession level indicator. In 2008, it's actually 2009 where it spikes. After the market was already down 40% is where you're seeing measures very similar to what we're seeing today. So that's pure panic from
To use a technical term, we're at puke point, right?
We are.
Is this a contrarian indicator, though?
It is. It's a contrarian. When you look at it, it tends to be an okay indicator. It's not perfect.
Sure.
There are times where it may not completely signal panic. And when we look at a lot of the other indicators, I think there's a good chance the bottom was in at a 10% pullback for a lot of these reasons. And we'll talk more about the tariffs later. But did you want to take the other sentiment indicator, which was just consumer sentiment?
Once again, the emotions. Surprise, surprise, there's a partisan take on emotions. Whenever Biden was elected, the Republicans were very bearish on the economy, had a lot of phone calls. Now that that's flipped, we're seeing the same thing. The Democrats, tariffs, inflation, a lot of concern in that survey, that soft data. So we can see that drop off since the election, where the Democrats, as a party, are bearish on the economy. It's not so much with Republicans. That's not a surprise. The key takeaway is the independents seem to be more neutral. There isn't a Democrat independent sentiment that's negative. It's mainly on one side of the aisle at the moment. That doesn't mean it can't make its way into the economy. I think that a lot of the movement that we're seeing in the market, where the dollar is selling off, there's a lot of movement towards international, Japan and other markets, are because it's not like that's a small segment of the retail investor. It's a 50%, right? So they're moving assets away in concern of that, which is that soft data that therefore will become hard data.
You mentioned the independents. In the chart, the light gold, gray, the independent line up top, looks really well behaved to me. It's in the ranges it's been in the past, and it looks pretty rational. It's hard. The Republican line barely dips from sentiment. There have been a lot of headlines, scary headlines. The independence dip makes a lot of sense to me, of what you would expect to see given the uncertainty. Just taking the example I used earlier, a great economic report, and the market can't even digest that number before we get a 200% tariff announcement. How is a business supposed to work its way through that? They can't.
Sure.
And that's what's leading to a lot of the uncertainty. And to close out, we talked about another signal that's really good. This is actually one that you've used for a very long time. Do you want to? It's yours. So
it's just looking at the 90-day option versus the current options and what's the ratio, because what it tells you is how much insurance are people putting on at the front end versus how much they're putting in further out on the market. And that gives you a good indicator of just how much of the volatility is getting priced in. So when you see that spike, that means people are very bearish in the very short term, but they're not as bearish in the long term. They think it's going to go through. So I've always liked to look at this to say when it's above that green line, well, that's a buy signal. It looks like we're hitting that point where it's just a lot of desperation, but traders in the market do not see this continuing on. They start to see a relief rally or some type of recovery priced in. Are we above that green line? No, but we're getting pretty close, and you can't make...
That's the spike, right? You referenced it. The initial panic is those days where the market's down 1%, and then you just see continued selling pressure through the rest of the day. A nonstop selling pressure. It ends up down tech's down over 3% on those days. That's that puke point selling, where eventually when that's hit those numbers, you see this is a buying opportunity.
Right.
And the good news that we saw last week is the sentiment report you talked about, is when that was released a month ago, you saw the beginning of that slide in sentiment, and it sold off the market. It was that the consumer's so afraid. Obviously, they know it's politically motivated. The market can see that. It's not, they're not that dumb when looking at the data. This time on Friday, that report comes out, market starts selling off. We had a nice rally beforehand because the government shutdown news was averted the night before, and we did not see a continued sell-off. The market rallied through the news, which is that good sign that the market's able to take bad news and continue moving higher.
Sure.
That's always a good sign. That gets us to really the fear in the market. And the fear can really be broken down to Doge, tariffs, and does this lead us to recession? Do you want to intro Doge a little bit? We haven't mentioned it yet.
Well, my intro to Doge is it's where it belongs on X. A lot of it, I see this as more marketing to put a narrative out there. We see a lot of cuts. I think things that Congress should be looking at personally, to give my bias away. But I don't see this really impacting. We had the continuing resolution. So basically there's a lot of questionable, depending on your take on the data, and then Congress, the House, the Senate moves to continue the spending level as is. So I think this is more of a marketing component than it is an actual realized cut. I personally would love some cuts in the government. I'd find that midterm to long-term bullish. But I'm not putting a lot into it as it is more of a marketing campaign issue.
I think Bessent said something really interesting last week, which was when he was meeting with the roundtable for businesses. He told them, I know your stocks are struggling right now, but if you guys had done what we're trying to do at the government level at your business, your stocks would be up 15, 20%.
We're looking at purchasing a bigger home right now. I'm running Doge on my personal expenses to try to cut them out, so I feel better about running it personally.
So I think we can summarize the Doge as not necessarily the big impact to the market. There's still that fear. There's fear that we're going to see those jobless numbers spike. We talked a lot about it last month. It's probably going to happen. And
there are people that are getting cut, right?
Right.
I don't want to downplay that. But I think we can go back to the 90s during Clinton's administration when we had this peace dividend because the wall had come down and there was a downsizing and layoffs within the government. Now, all kinds of games where people were changing titles, and you can't step in the same river twice, so I'm not going to say it's exactly the same. But there was layoffs in the government while the private sector picked those up. And a lot of those employees that are at the government, it's not like they're uneducated, unskilled. They have skill sets that are marketable, so it just moves them into the private sector so long as the private sector can absorb it. And what we're seeing is right now they can.
That's the bullish part you said, right?
Right.
That there's going to be a rise in the initial claims. We will see that over time. And I don't think the market's going to be surprised by that. Everyone's saying that's coming. It's then, does the private sector start to pick up some of those jobs?
And so far the hard data says they have been, right?
Mm-hmm.
The JOLTS and other indicators are that there isn't a lot of unemployment.
So that gets us to the real uncertainty that I think is the main driver of markets, and that's the tariffs. And that's because a business has a really hard time struggling with a different tariff announcement every day.
Right. If you just set them in, the economy will figure it out. I think an example that we've lived with for a long time is we have tariffs on sugar. Why? Because we want to help the Florida sugar cane over the sugar cane that's grown in the Bahamas. That's probably the whole reason we have high fructose corn syrup is because it's expensive to buy American sugar, so we found alternatives. And I would love it if those tariffs were removed and we went to a national economy, but the economy functions well because it's a stable thing. Everyone knows it, and you can start to do comparative advantage and set the thing up so countries are able to still focus on the things that they do well, and our countries are able to do. There's some inefficiencies there, but businesses figure out so long as it's stable.
They need to know, and that's why we think we're towards the end of the sell-off. As April 2nd is the reciprocal tariff announcement, and this is the big risk the market faces from our opinion, which is, do those tariffs stay flat or come down? Do we start entering a trade war where maybe the administration gets a little frustrated and pulls back from the reciprocal tariffs and actually raises them? That's the bear argument from our opinion, which is, you just said it. Businesses will work their way through once they know the rules of the game. Right now, They have no idea.
Right now, I think it's a game of chicken. That currently the administration believes that there are unfair tariffs being placed on U.S. goods, so they've raised the tariffs to bring them to the table. And if they're correct in their game, and they're able to then move tariffs down on the U.S., we actually get a freer tariff. Now, that may not work. There may be a retaliation. I don't think politically that hurts the administration either way because there's an emotional response. A lot of people feel like they have been given a rough deal in these tariffs. So if tariffs stay high, I think it's a win for the administration. If the tariffs go down and there's reciprocal bargaining, then that's a win for the administration either. So I think that's the big thing is how does this actually play out?
And just the summary of that is tariff certainty is a lot better than the tariff uncertainty that we're in now. And that's why I think the market giving back its 10% pullback, I think we start to rally and recover a lot of that once we start getting past this.
If these countries come to the table and they start to remove tariffs and there's certainty that it's going to really take off. But even if they just say, okay, we're done, it's going to move the market up.
Yeah, businesses can move through it. And two more pieces I want to put on why we also think that will happen is we have seasonality on our side. This choppy start to the year is normal. Now we overshot it certainly. This is a 20-year composite of the S&P 500 looking back. That January through February of this year looked almost identical to this chart. The difference is that pullback that happened in late February was much larger this year. We would have been under the zero mark, down a few percent, but heading in towards the rest of the year, you start to get this strong recovery. Right at the same time, we're going to get more certainty with those tariffs. I think it's really supportive for the market going forward. And finally, to just acknowledge the pullback that we had, it was extremely fast.
Yes.
This chart, complicated, but we've used these a lot, looks at the past pullbacks of 10% correction under 20 days. And there's been a handful of them. And the general trend is when there's this shock that happens that quickly, there is a recovery that happens 3-6 months going forward at a much higher rate than the normal recovery in 3 to 6 months. That's what the bottom part is. Bottom part is just looking at what the normal market would do over time. The top part of the chart is what happens after you've already had these big pullbacks. So that gets us to looking forward. What would really be our conclusion? We already said we think there's going to be a recovery, so we're staying invested, not making large changes there. But how do we think this is going to play out?
So are you asking, do tariffs work?
Yeah.
Tariffs, as economic theory, no. It's not a good idea to blockade yourself. Blockades are acts of war. At no point do you blockade a country and be like, man, their economy is really going to run.
And we taxed ourselves with the tariffs. So really nice about taxing our consumers.
So when we put tariffs on, we're putting a blockade. It's not a good idea. Now, to be fair to the administration, I don't think that's their argument. They're trying to use it as a bargaining tool, and hopefully they're able to lower overall tariffs globally. But at the end of the day, I don't think this is really going to matter. As long as economies are reasonably free, they figure this stuff out, and we are able to figure out what do we still do well. Let's invest in those so that we can trade, and what do other countries do well. We're just going to make those trades, and there's some type of friction cost that's a tax. In addition, the administration says they want to replace the income tax with tariffs. This is not going to happen. I would love it if it did. You'll never be able to generate the revenue from tariffs because it's something that you can control. But if they can mitigate some of that, it probably would be more control of the consumer. Ultimately, it would be better for the economy to have tariffs versus income because there's some control. I still don't, it doesn't keep me up at night. I think we're going to get past this soon.
I think we move past it, and I don't know if this is a good thing or a bad thing. Market recovers, businesses work through it exactly as you said, and both sides we'll point to it and say tariffs didn't work. But I think the administration could also say, no, tariffs worked, and you have this classic policy example where both sides still don't agree.
Right.
But end result is businesses work through it, and we have recovery.
And both sides don't ever agree. I always love the thing. It's like at no point we were open a Wall Street Journal and say, hey, everything's good, go ahead and invest, right? It's always a thing of uncertainty and disagreement in the market. That's how markets work. Yeah. Why don't you tune in next month And we'll see how well our predictions work. Hopefully we don't have tariffs in the headline anymore whatsoever. We have a recovering market, and we're following that path that we were looking at whenever the seasonality, where we have a strong month and we continue to do the upside for the remainder of the year.